All right. Hi, everybody. My name is André Beganski, and I'm a staff reporter at Decrypt. Very excited for the conversation that we're going to have today. It's going to focus on liquidity and 24/7 markets, whether that makes them inherently fragile. It's important to note that we're having this conversation within the context of the biggest liquidation wave ever in crypto history. Last Friday, $19 billion worth of liquidations happened in the crypto market. That was more than the COVID crash, more than FTX, more than the tariff sort of debacle that we saw in April. So with that, I'm going to turn to people to introduce themselves. But one of the things I'd like to know from your guys' perspective is what stood out to you most during this historic crash that we had not too long ago. Amanda, do you want to start?
Sure. Okay. Hi, I'm Amanda. I'm the executive director at the DeFi Education Fund. We are a nonpartisan nonprofit dedicated to advocating for sound DeFi policy that looks like advocating for software developers and for users of DeFi wherever we can, in rulemaking, in court, with lawmakers, and we also do a lot of education, explaining demos of how DeFi works, how the tech works, all of that. Should I answer your question now? Or?
Yes, please.
Okay. And I would say that the thing that stood out to me the most is that decentralized systems like Uniswap and Aave and DYDX performed through the entire liquidity crisis. And that is, I think, a testament to the resilience of decentralized technology.
Thanks, André. I'm Greg Xethalis. I'm the general counsel and a partner at Multicoin Capital, which is an asset management firm in the space. I'm also a director of the Blockchain Association and the DeFi Education Foundation, which is an affiliate of DeFi Education Fund. And I think, for me, not a legal or policy observation, but a practical market-based observation is we're now entering into a world where increased adoption of digital assets is giving the world economy access to something that is always liquid and always available. And that means that when news comes out after a market close on a Friday night, and we've seen this a couple times, the asset that the global economy looks to as a proxy for information on sentiment is increasingly crypto markets. And that exists both on decentralized platforms, which performed remarkably well throughout the weekend and functioned as expected, as intended, as well as centralized platforms, which did function but had some hiccups in the level of liquidity within order books. Georgia?
Thank you. Hi, I'm Georgia Quinn. I'm the Chief Legal Officer at Securitize. I just want to say thank you and thank you to Chris, wherever you may be, for inviting me here. So at Securitize, we tokenize securities. That's it, just securities, not anything else. If you want to tokenize something else, go somewhere else. But if you've got securities, you need them tokenized, that's what we do. And we'll get into the process of that and the different mechanisms behind that, but there's obviously the goal when you're tokenizing securities to be able to trade them in a very highly liquid way. And so I'm hoping that we can unpack that more today. And then my observation of the past week or so is really that when you think about all the other events that you just mentioned, those and how they kind of pale in scale of what we just experienced, it sure doesn't feel like that at all. Like when we went through FTX and the Silvergate crash and all of those other events, Terra Luna, that was momentous, and it was like an earthquake through our entire industry. And I didn't really feel too much.
So Plume, so my name's Salman, Banaei. I am general counsel at Plume Network Inc., which is a project that is trying to tokenize securities as well as other real-world assets, including camels, durian farms in Southeast Asia. What's another obscure one? Microfinance loans for tuk-tuk drivers. These are these chariots that are popular in Thailand, among many other projects that have launched tokens in the Plume ecosystem. The Plume blockchain itself, it can be seen as a compliance layer for Ethereum, so it's a layer 2. protocol that is the only layer 2, maybe the only public blockchain that has embedded sanction screening at the transactional level. I have a little bit of experience with flash crashes. So I got my start as a regulator at the CFTC in 2009. I was in the market surveillance unit on May 6, 2010, when we had the flash crash, which initiated based on a large mutual fund hedging their portfolio in S&P futures. And it was during a volatile time. Market sentiment was very mixed. Nobody had a lot of conviction. And so that large hedging transaction led to the transmission of pricing information that was interpreted by the market as something more than what it was, which was one mutual fund in a time of uncertainty hedging its position by selling shares in S&P indexes. There's a lot of parallels, actually, with what happened last week. DeFi performed well from an operational risk perspective. It did exceptionally well. From a market risk perspective, though, crypto as a whole, there's some lessons learned. And at its core, wasn't actually DeFi. It was a pricing oracle at one of the centralized exchanges, which maybe our friends at Chainlink can help them improve. But what we had was a market risk phenomenon, which was very quickly reversed. And I think most tokens have recovered since. So I think one of the lessons learned is as this ecosystem grows, it's well positioned to adapt to these types of phenomenon. One of the things we saw after May 6, 2010, the flash crash, was we started to see new trading strategies that were looking for these falling knife events. And so I think in DeFi, we're also going to see new trading strategies that are going to spot these market risk phenomena and trade against them. And so when these phenomena happen, their severity will be reduced because of these new trading strategies. And as more money comes in with additional regulatory certainty, we can expect a diversity of trading strategies that will limit these tail risk events in the markets.
Well, thank you for that, Salman. I think we're going to talk a little bit about the role that market makers potentially played in the crash last Friday. I don't think we have a full picture yet of exactly what happened, but sort of the conditions in terms of liquidity drying up are notable, and I'd love to get your thoughts on those. But before we really dig into the nuances of liquidity, I think it's important for us to establish what we're talking about. So, Amanda, my question is for you. The DeFi Education Fund advocates for policy clarity. What are the biggest misconceptions regulators have about liquidity in DeFi?
Sure, yeah. So I think there's a few misconceptions at the most basic level. One, that we don't want regulation, which is not true. We do want regulatory clarity, as you baked into your question. And then also that there is this misconception that somewhere in a decentralized network, there has to be an intermediary somewhere that can do something that will look like how it looks in traditional finance, right? And we are talking about the traditional finance, which is an intermediated system, right? There is a person who can block your trade, keep you from accessing a network, or delay settlement on a trade. In DeFi, that kind of entity does not exist. There is no intermediary. And the reason that exists, it can function that way is because we trust in code to help us engage in self-directed financial transactions where we custody our own funds, right? That's how DeFi works. So I think one of the biggest misconceptions there is that somewhere in the liquidity puzzle, there is going to be that intermediary that can do something. But instead, it's really making sure that the code functions the way that it's supposed to. Salman talked about operational risk. Like that means that there are people who are good stewards of their private keys, that there are people who are making sure that the system that accesses DeFi operates the right way. And I think one last misconception is that liquidity in DeFi is only for big institutions and not for the individual person, and that's not true. Many people are greatly benefited by liquidity in DeFi. There are many stories of people who are able to earn an income because they provide liquidity to a liquidity pool. And we are privileged here in the United States to have a stable currency. Other places in the world that is not the case, and people are able to earn a much more stable income by providing liquidity in DeFi.
It's always important to think about DeFi as sort of a global phenomenon and one that's not necessarily limited by a jurisdiction. You know, you talked about regulation there as far as something like DeFi isn't saying that it doesn't want to be regulated. You know, Greg, I think turning to you, from Multicoin's perspective, what legal frameworks are most urgent for on-chain liquidity providers?
So, you know, first, you can provide liquidity through centralized fora, or you can provide them through DeFi, and those are going to be different. Centralized intermediaries, centralized platforms, whether they are lending operations, derivatives platforms, or exchanges, are going to be regulated just as if they were traditional centralized intermediaries. Market structure legislation that is working its way through the Senate is focused on regulatory frameworks for those intermediated players. Just because something is crypto doesn't mean that there aren't intermediaries. It's just that those intermediaries are the Coinbases, the Krakens, the what have yous, the CMEs of the world. So pulling aside that framework where I think it's reasonably well understood how we're going to address regulating those intermediaries, or at least somewhat well understood. DeFi is a little bit different. When you're providing liquidity in DeFi, first understand that these are systems that, as Amanda said, that are autonomous, not controlled by any party. They are very well, typically and hopefully very well audited code that is designed to function not through an administrator who is managing or monitoring the system, but instead through thoughtful code that contemplates both the game theory and the economic incentives of the participants in a DeFi platform, as well as being designed to operate in an antagonistic environment. One where, you know, you would expect people are going to be trying to find loopholes or flaws in code, flaws in the risk metrics that have been encoded into the design. One of the significant areas of concern there is actually around collateral and liquidity provision itself. And when we look at how these pools operate, the most simple is, you know, a swapping or a exchanging function in DeFi, like an automated market maker, where people will provide liquidity into an AMM, which will allow people to have a trading counterparty for these atomic exchanges of one asset for another in a very well understood, well-designed system that rebalances the price based on the assets in a pool. Different from that are what we typically call as borrow-lend protocols, but it's important to note these aren't actual like lending platforms where there are contractual obligations from one party to another. So if I provide liquidity into Aave in a borrow-lend platform, I don't have a right to enforce legally a return of my assets. Instead, I have a power to provide assets back in from that wallet to a vault to reclaim the collateral I have posted. And then the third real silo is something that looks a little bit more like a derivative, where I might be posting assets, again, as collateral. And under both of those cases, both derivatives and a lending-oriented one, you know, what we're looking at is how is the infrastructure of the DeFi platform designed to manage the loan to value or the collateral level, and how can it respond to significant movements? And it's incumbent upon the people who are initially designing these systems to think about what type of collateral is permissible, what type of haircuts are applied to collateral, how do you manage. Most of the significant issues that, for example, occurred over the weekend related to collateral that was not as robust. So people were getting liquidated not on positions collateralized with USDC or typically with Bitcoin, but with things that took big gaps down. And that's part of the framework on design. And I think when we're looking at the objectives for people who are providing liquidity into these platforms, the first and foremost is making sure people understand what they are doing and making sure that systems have easily understood textual explanations. The code is source available, So if if you speak C++ or Rust or Solidity, you can understand these things. I'm a human being, and I do not speak C++. So I need textual explanations of how these systems function. And I've realized I've been going on for a little while. One thing I would note is this past January, the great Sigal Mandalkar wrote an article bemoaning the fact that our government regulators aren't allowed to own, use, and try out different aspects of DeFi. And if you want to understand these things, you have to play around with them. You've got to become familiar with them. You've got to understand how they work through testing them out, as well as diving in and understanding how they function from a textual basis. But currently, the Office of Government Ethics doesn't permit government employees who are working potentially on the regulation of crypto from owning, testing, toying around. It's one thing that I would hope to see the administration rewrite and revoke that guidance, because it's very detrimental towards getting good crypto policy in general, but particularly as it relates to DeFi.
You need to be elected president, I think, to be able to.
I think you might want to speak into the mic. Oh,
Sorry, I was making a bad joke, which is I think you need to be elected president to trade in crypto.
Greg, something in terms of what you said right there is about code being law. And I find it really interesting that not only is this something that institutions have to navigate, but as well as individual investors. And, one of the unique elements about DeFi is this idea that, people really are on the same footing from the perspective of just engaging with these services. But, Georgia, one of the things when we talk about code as law is, the idea of how safeguards apply. You're somebody who's been in traditional markets and digital markets. What do you think carries over well and what doesn't?
Yeah, so I think it really comes back to the fundamental difference of intermediated systems and non-intermediated systems, because the law needs a head to roll, right? The law needs to be able to point to somebody and you did a bad thing and you will be punished. But when we're talking about code, it's not an individual. And so I think, for me, and you guys would probably disagree with this, but I don't look at code as law. I look at code as a tool and a product and something that we can all use, and we all just agree to use it or we don't. But we're not going to be able to go and sue the code. So that's why it's a little caveat emptor, in that you do have to have the appropriate disclosures and understanding about what you're entering into. And frankly, I don't know who gets in trouble when those disclosures aren't fully accurate, but it probably should be somebody.
Can I make one point, Georgia?
Yes, please.
I first agree wholeheartedly that code is not law, law is law. What though is interesting that attaches to that point is within truly decentralized systems, the code does govern, not in that it establishes individuals' rights, but in that it establishes the powers of everyone who interacts with the systems. So everyone is playing in the same sandbox by the same rules. And that's, again, where you have this concept of building for an antagonistic environment, because there is no one who can be an arbiter and a legal recourse within those systems, generally speaking.
Right, and in many ways that is a feature, because we have spent, this country has spent 100 years now, building up controls and systems and regulations to ensure that we can protect people from ourselves, right? We have to protect them so that that finger at their, broker doesn't accidentally liquidate their entire position. We have to protect them that a bad actor at their bank doesn't steal their life savings. In this instance, we don't have those issues, right? Because we now have a code that is pure, it has no motives, that is performing all of these functions. And so I think that I'm very excited to see, to have a little time horizon on this and see what performs better. Humans with all of their flaws and the need to create layers and layers of regulation and controls, or code that can be drafted, ex ante with, these sorts of protections built in at a fundamental level.
Just to chime in here, I'm not convinced that code is law either at this point. I think when you do see DeFi projects encounter things like exploits or hacks, very quickly that sort of veil can fall down for projects where they take sort of radical action, whether that's coordinating people that are involved in these systems to act quickly, or in some cases, exercising control. Salman, that's obviously a safeguard when it comes to sort of managing risk in protocol-based finance. What do you think can help reduce systematic fragility in the space?
Yeah, so at a technological level, DeFi is a unique innovation, really a risk management innovation in some ways, in that it's achieved unprecedented levels of transparency and enabling radical levels of automation, which you see, for example, through 24/7 availability of on-chain infrastructure. And the combination of these two features also enhances what I call the self-healing properties of DeFi, which is the ability of the market to spot vulnerabilities, that arising out of this PvP, player versus player nature of DeFi. That also enhances the ability of the DeFi system overall to adapt, which is an anti-fragility promoting feature of DeFi. We're a bunch of lawyers, so let's talk a little bit of policy. The ecosystem, I'd like to see evolve, and in some ways we've already achieved, is we can have a universe of DeFi developers that don't need government approval for launching a new protocol, launching a new app. But the next phase that we need pathways for regulated institutions to be able to use this technology in a safe way. We've made considerable progress. I think the market structure bill does a great job of protecting the developers. I think it could use some improvements, though, in terms of providing those pathways to enable regulated institutions to start participating in this ecosystem, because ultimately that's where the capital is. And with the capital comes liquidity, and with liquidity comes enhanced systemic stability.
Can I just share one?
Of course.
Little baby step. So at Securitize, okay, sorry. So at Securitize, we are taking small steps to, engage with institutions and bring them into the DeFi space. And one thing we've been able to do is work with certain DeFi protocols to allow tokenized securities. So these are SEC-regulated tokenized securities to be pledged as collateral natively into the DeFi ecosystem, and then you receive the native DeFi token, and you're able to participate in that ecosystem. And this has been a really nice way because it still maintains that level of separation, right? The actual SEC-registered security is never breaching and entering into the DeFi ecosystem, but it allows the investors and the holders of those securities to have access. And so, I feel like it is a small step that we're able to do, coming from the more highly regulated side.
I hear what you're saying about sort of the separation of those two things and them being able to coexist to an extent. I want to sort of turn our focus back to what I brought up at the beginning of this conversation, which is our flash crash on Friday. We talk about the PvP environment that's inherent in DeFi and how that's different from traditional finance. Market makers are something that I've seen come up in reporting in terms of, liquidity drying up quickly and to some extent a coordinated retreat among market makers. I would just love it if everybody could chime in terms of how those incentives between participants in DeFi systems versus traditional markets really showcase themselves here to an extent, if they did, or maybe they didn't.
I might quibble with one thing you said, because the traditional markets are also quite PvP. I think there's a greater expectation, or there's more layers of compliance controls and more of an expectation that, hey, if I do something, a little aggressive, I might expose myself or my company to more risk. I think there's more of that sense. There's definitely that sense in crypto too, but in TradFi, I think just given the layers of supervision at the regulated institutions, it's more pervasive. So with that one quibble, we can continue the discussion.
No, I appreciate that counterpoint because I do think when you talk about DeFi, the PvP nature does come up a lot. And so saying that, this really isn't different from the conduct that you're seeing in traditional finance, I think is important for people to understand in terms of just how there are similarities. And at the end of the day, these are financial market participants.
Yeah, I think, and that's a great point, Salman. I think the distinction is the code for DeFi is designed to create a fair platform for participants based on the committed code. Whereas in centralized markets, we rely, whether this is the CME, whether it's ICE, whether it's Coinbase, we rely on the market operator to establish and follow rules and do so transparently. Whereas in DeFi, the code fulfills that role. Everyone is on equal footing on a DeFi platform. Just as in any blockchain network, everyone is an equal. All you need is a little bit of internet access and that startup capital to pay your gas fees, and everyone is an equal. As far as the market makers, I think it's an area of evolution in crypto markets. Market making is certainly different than it was 3 years ago, and 3 years ago it was different than it was 6 years ago. The market is evolving, becoming more robust, becoming more resilient, learning from mistakes, and the structure of even the centralized crypto platforms often looks slightly different than the existing TradFi markets, whether it's broker access versus direct access or FCM access versus direct access. And I think we will see a lot of focus on market makers going forward, whether it's market structure regulating dealers in the space. And when we look at this past weekend, I think it's too early to really dig into a postmortem because we don't actually know fully what happened, other than, as Salman mentioned, the markets have responded. And as Georgia mentioned, this was very different than the experiences of early 22 with Luna, where the market wasn't able to absorb the supply shock of credit being withdrawn from the market. And instead, we saw a significant pullback based on extrinsic factors to crypto. And we saw instead crypto being utilized by global markets as a way to express an opinion on the news of the day, which unfortunately also led to cascading liquidations on certain collateralized platforms.
Thank you for that. Georgia, I think you're a great person to weigh in at this moment because of what Securitize does in terms of issuing tokenized assets that people would call sort of native to an extent, where they carry the same rights that you would get traditionally if you bought stock through your brokerage account. One of the considerations here is that people are tokenizing things, but as Hester Peirce pointed out this summer, sometimes that can look like a synthetic asset, and it being synthetic when markets are closed, there's this potential for asset prices with these synthetic assets to deviate from ones that are native. How does Securitize think about this in terms of market risk when it comes to native assets versus synthetic assets?
Yeah, and the market doesn't even have to be closed for that deviation. If you want to pay 10 times as much for some wrapped Tesla, you are welcome to it. But I think at Securitize, we understand the problem, right? We prefer what we call the issuer-led model, where the issuer wants to issue securities and they want them to be in a tokenized form. So they are natively issued on a blockchain of their choosing or multiple blockchains of their choosing, and the actual ownership record is the blockchain as augmented by PII. That is a harder road, right, than just going and buying up a bunch of Apple stock or other things, putting it in some sort of SPV and selling tokens of that. So I get speed to market and why people want to create these synthetic versions, but ultimately, that can't be our goal, because that's going to create these little pockets of non-fungible assets, because they are not the same thing, right? That thing that I bought is now wrapped in my credit risk, and I'm issuing that underlying thing plus my credit risk to someone else. Versus in the issuer native tokenization, those investors have a direct claim on the issuer, and they have all of the same underlying rights as the actual stock or note or whatever the underlying security is. And in fact, it, for most purposes, is the underlying security. We'll talk about UCC some other time. But it is quite different than a lot of these other instruments that you're seeing, where they are either acquiring them and holding them in a custodial basis, or actually creating other vehicles to sell those assets. And you'll see that's why, for the most part, those kind of things aren't being offered in the US, because those actually become another security that has to find either, be fully registered or find some exemption to be sold in the US.
We're going to call that a layer 2 security?
That's good. That's good.
Georgia, just to dig in on this just a little bit more, I've talked to people who are in the business of issuing these synthetic securities. One of the things that I've heard them talk about in terms of a talking point is this idea that native assets have certain considerations that need to be made around custody, particularly like the idea that it could be challenging for me to own a native asset in a self-custodial wallet to an extent. Do you sort of see native tokenization as having limitations compared to the synthetic approach
in
some
got
ways
some limitations,
in terms of,
but custody is not one of them. So I'm going to call a little bullshit on that guy. You can tell him I said so. And no, there's no issue. And we have, multiple issuers that issue direct to the wallets of their investors. Also, if you don't want to self-custody, you can have a custodian custody it. And you don't like that, you are more than welcome to use, go back to your broker-dealer, put it in street name, and put it back in DTC. And that's, something that people don't really talk about much as well, but because we kind of sit on the connection point between traditional finance and digital assets, we do have investors in our issuers that move their assets back and forth from book entry form to tokenized form, depending on the activities that they're engaging in. And that is, it's not seamless, but it is very possible, and people are doing that. And so custody is not the problem. Secondary trading, that is a problem. That is a problem because especially when you're talking about NMS securities, publicly registered securities, those assets have to be traded on a national securities exchange. And these tokenized versions of them will not qualify to be listed on a tokenized on a national securities exchange. And so there are other alternatives like ATSs and other things, but there are these rules. I'm going too much rules. But there is a rule called Reg NMS that you have to comply with that is becoming a little problematic. And I think that's where we're going to see Chair Adkins and the SEC staff focus a lot of their attention. Because number one, he already doesn't really care for that reg very much anyway. And number two, it is actually becoming an impediment to the secondary transfers of tokenized securities.
There's also the PII collection and from collections that have to happen with shareholders. That's another impediment to on-chain equities.
And just
not for me, but
two quick observations. One, you also still have the ability to get your share not in your Schwab account, but on a paper form. It's an older form of media, but you can still get your paper certificate. And in fact, they all sit with Seed & Co. as the name owner presently. Secondly, for those of you in the room who have not read the American Leadership in Digital Technology Finance, the Project Crypto speech from Chair Atkins from 2 months ago, I would argue that it's probably the most important collection of words about the blockchain industry since, if not Satoshi's white paper, then the Ethereum white or yellow paper. It is remarkable. And the one thing I would note, which goes to George's point right now, is that speech, Chair Atkins puts a call out to the staff of the SEC that we will work on rules to allow people who want to bring financial instruments on-chain to do so. It does not mean we are suddenly up and porting everything from legacy finance to blockchain, but it's a recognition that if we don't figure out these tough rule issues, largely in the 34 Act, from a securities law side, that we are stunting our ability to improve the system writ large and utilize this technology.
And if I could just follow up on that, I think one thing that's very important that Project Crypto and the SEC Crypto Task Force is working on is figuring out how tokenized securities might someday trade on DeFi. And I don't think that there is perfect clarity at all as to how that might happen, but I think it is coming. It will happen whether we make rules or not. So I would argue it would be much better if we had some forward-looking rules on how that might happen. But it's important to think about where those rules are placed, and I think everybody's made this point at some point. There are already regulated entities, people who have already registered with the SEC or with the CFTC that are able to comply with these rules right now. They are able to make disclosures about the DeFi protocols that they might plug into, that they might give people access to right now, and that allows all of us to benefit from consumer protection and allows us to understand better what those DeFi protocols are capable of doing. So I think that, at least my expectation is that the SEC will provide that clarity to us, maybe even faster than we get market structure, but like we'll take it either way, right? Like we want to understand, software developers want to understand, users want to understand what the rules might look like so that tokenized securities can trade in DeFi.
And
Amanda,
this,
sorry. Amanda's making a great point, which is what we're likely to see in the mainstreamization of DeFi is a sponsored access model whereby existing registrants will be using DeFi protocols subject to conditions imposed on them by the commission, largely to make sure that the traditional goals of securities regulation are still being met, even as this new technology is being deployed. And that'll be informing a broader approach to DeFi and within the regulatory architecture of U.S. finance.
That's a really interesting concept. Maybe at its most basic, are you saying that the commission could look towards sort of policing participants more than the platforms themselves?
No. So the SEC's jurisdiction extends through its 4 primary organic statutes, the 34 Act being the biggest one. They have jurisdiction over those 34 Act registrants. And through their approach to regulating or exempting those different registrants, they can apply standards around sponsored access to DeFi protocols and DeFi infrastructure.
Well, thank you. Amanda, I wanted to sort of give you the sort of last question as we sort of put a button on this conversation around on-chain liquidity. When it's Friday and sort of prices are plunging for cryptocurrencies, one could naturally think of circuit breakers, somehow finding their way into the crypto market over time. But, if anything, this conversation has really showed how DeFi, to an extent, will always be separate from traditional finance. Do you think something like a circuit breaker has a place in DeFi? What other sort of speed bumps or considerations do you think are part of the dialogue today?
Yeah, I think assumed within your question is like DeFi is always on, right? 24/7, there is no off button, and that is because code is autonomous. So when we are talking about a decentralized system where there is no control point, there is no person or entity that has unilateral control over the network or the assets in the network, there is no one that can flip a switch and say trading stops now. There are front ends that connect to DeFi that in theory could possibly block access through their front end, but that just means there are a million other front ends that can access the same protocol, right? So DeFi is always on. There are risks in DeFi, but they are different from the risks in TradFi. And I think that it is important to understand why DeFi was created. And I will not go on too long, I promise. But as a result of the 2008 financial crisis, our trust in traditional financial institutions was broken. That was because of a lack of opacity, right? A lack of understanding what was going on in financial institutions. And as a result, Bitcoin was created so that you would have a totally transparent, automated payment system that people could send value back and forth, peer-to-peer, without any third party being involved, and everyone could see on the blockchain what was going on. DeFi further iterated on that and said, we're going to create other ways to do finance on chain. So not just payments, we're going to do lending and borrowing, as Greg talked about earlier. We're going to provide the ability to trade all sorts of different assets. And because this was created to be a trustless system, the risk is not from opacity. It's not from not understanding what's going on, because everyone can understand what's going on. The risk instead comes from cybersecurity more than anything else. When you hear about a hack or an exploit, you are hearing about a cybersecurity issue. You are hearing about code breaking, or you're hearing about an OPSEC issue. Somebody was scammed, right? Somebody put their private key in, meaning they put their control access to their wallet, their password, right? Somewhere where somebody had access to it, and then people were able to access a system that they shouldn't have been able to, or move money that they shouldn't have been able to. So the cybersecurity risks and OPSEC risks are things that we can address by addressing those. But those are addressing code, those are making sure that we can audit code, making sure that it is well audited and it's functioning well, but it's a different kind of risk that we have to control for, but it is doable.
And André, one last point, because I see Adam coming up. We have to also remember that the solutions that we look to for new markets must be designed for those new markets. So DeFi and circuit breakers, kind of tough. But one of the other components just generally within crypto, and you look at circuit breakers, it's something that works quite well in US securities markets or global securities markets where you have a primary listing exchange and a consolidated order book. In crypto, you don't have that. This stuff trades throughout the globe, arbitrage throughout the globe, different venues. So the only thing you implement with a circuit breaker is a dislocation of one market from the rest of the world. And so that doesn't mean we can't come up with solutions to throttle risk and design them, whether on centralized markets or even through risk parameters as you're designing a DeFi protocol. But we should be careful not to fall into the trap of thinking that yesterday's solutions will always work for tomorrow's products.
It's a good point to end it on. That's it for the conversation, everybody. Thank you for listening.
All right. Thank you all. I feel smarter. 35-minute break. And then we're going to come back here for final panel on custody. So come on back.